Hi everyone, welcome to today's video, and in today's very important video I am going to discuss with you why I think it's so important for everybody to actually separate technical analysis from trading itself. I know initially right off the bat that sounds very counterintuitive, but you'll understand exactly what I mean by the end of the video. The basis of it is that whenever we look at markets and we've been trading for some time, we've developed some sort of belief system and we have an idea in our minds of what trading is. We may not realize that at first, but we do. Now, we have to be very sure that when we do technical analysis, we are looking at the market from an objective point of view and not a subjective point of view. And this is exactly why I say, as traders, we need to separate technical analysis from trading itself. Whenever we go into the market and do technical analysis, we need to make sure that we understand that the technicals are done from an objective standpoint, which means that we can almost imagine that we are not actually going to be trading the market while we do our technical analysis on it. You see, what happens is, if we come into the day, say it's a Wednesday, Tuesday was a very bad trading day, and let's say Monday was also not a good trading day for us, and we did our technicals, we looked at our strategies, and we kind of had a short bias those previous 2 days, but the market ended up rallying. You see, what happens now to our psychology is that on Wednesday we still have the remnants of yesterday's trading session and the Monday's trading session still fresh in our minds, and so we've built up a subjective bias while we look at the markets, and we still subconsciously expect it to go down. So when we're doing our technical analysis, like I said, instead of doing it from an objective point of view, we do it from a subjective point of view, and then we see things that actually are not there. Now, I know that this may not have entered your mind before, and as traders, of course, we just think that everything we do is, by the book and we can do it correctly, but the fact of the matter is it's not that simple, because if it was, we would all be very rich and we would all be good day traders by now. What do we do going forward with this inside of our minds now? Well, the first tip will be to look at the market as if you're not going to trade it today. So you have to actually try and trick yourself, and this could be done if you do your technicals. Say you start trading at 8 a.m. Central Time, just at the market open. You could maybe do your technicals an hour before, and you just create the situation where for the next 30 minutes or however long it takes you to do the technical analysis, you simply just say, right now I am trying to do the best technical analysis I can possibly do. I'm not trying to get a subjective view, and I'm not trying to build a bias inside of me whether I think the market is going to go up or go down at this point, because that is when I am going to be trading. When I'm trading, that's when I can make those kind of decisions. This also brings us onto the point that most of us do not do technical analysis correctly, especially if we're using indicators. Indicators kind of have a bit of a stigma attached to them in the trading industry, where some people who have tried to use indicators in the past have found that they are not very successful with them, and then think that all indicators are not going to be useful. And this is because whenever most traders put an indicator on the chart, it's because, and when they trade from it, they are relying on that indicator to make the trading decisions for them, instead of allowing the indicator to help us understand the strengths and weaknesses of the market, whether the bulls or the bears are in control. We put too much of our attachment in that specific indicator and expect it to give us the results that we're looking for. So why is it that most traders don't use indicators or technical analysis correctly? Well, if we look at indicators solely, it's important to understand the strengths and the weaknesses of any indicator before we use it in a real money trade. One of the most common mistakes that new traders make is to start placing these indicators on their charts without having a real understanding of the calculations behind the indicator or the way it is best used in analysis. Some might say that a full understanding of these indicators is unnecessary. So they say buy if prices fall into oversold territory, or just sell if prices reach overbought territory. Unfortunately, trading is not this simple, as we know. If technical analysis was this easy, everybody could be a profitable trader. Even further, we could just simply set software applications to find these signals and then walk away as profitable traders. The reality is that trading takes more work than this, and we will need to do a good deal of homework before we can make our indicators work for us in a consistent and a repeatable manner. Not knowing the formulas behind our indicators is not an acceptable practice, and it will negatively influence our trading results. Without this, it will be much more difficult to understand the true application behind each type of indicator. There are many indicators that we can actually use to enter into trades, and there are some indicators that we can use to exit trades as well. For example, in our previous video, we used the pivot points indicator to show you how a very basically calculated indicator can help us in setting profit targets for trades. But this does not mean that we have to basically rely on all of these indicators to make our trading decisions for us. When it comes to trading, because we've had such a difficult time in regards to the psychology part, we do not want to be in a position where we have to make difficult decisions anymore, because we are making our decisions from the emotional side instead of the logical side. So what this ends up doing and forcing us into is a place where we do not want to be under that stress anymore. So we would much rather just put on indicators in the chart, create a couple rules around them, do a simple back test and say, okay, this looks good. Let me just buy when I see a cross in the MACD, for example. If we are doing this from a side that is logically based and a place where we have done a lot of back testing, and it's not something where we are completely relying on the indicator itself, then this definitely can work for us. But like I said, most traders do not use indicators, but most traders are actually used by the indicators. I'd like to direct your attention to 3 indicators that we have up on the chart right now. We've got the dynamic money flow, we've got the MACD, and then we've also got the stochastic. Now, if we start with the stochastic, the only thing that I want to explain here using the stochastic is that most people have used the stochastic before. They've put it on their charts and they've taken trades using the indicator, but most people don't actually even know what the stochastic represents and how it's calculated. So a stochastic indicator presents the location of the closing price of a market in relation to the high and the low range of the price. This can be done over a period of time, which is usually 14, but this just gives you a good idea that most traders don't even know how this indicator is calculated or what it's actually showing. So traders, the idea of this video is not to explain to you how these indicators are calculated and how all of them actually work, but the idea here is to show you how important it is for us to, at a bare minimum, at least understand how these indicators are calculated and what they actually do in relation to the price chart, so that we know at least going forward what this indicator is plotting and what it's actually showing us. You know, for example, we've got the dynamic money flow indicator on here, and this is one of my favorites. But most traders, what they'll do is they'll put on this indicator and they'll say, okay, it looks really nice. Whenever the moving average band, which is red over here in this case, is like this, it's red, let me take short trades. Or maybe whenever the actual indicator line, which is the green one, crosses below the 50 line, then I can take my trades. Most traders wouldn't even look at it and say, what does this indicator actually represent? What am I actually looking at here? And you'll see that once I tell you that the dynamic money flow index is telling us how much money is basically flowing into and out of the asset. And so we have the 50 and a 100 moving average here band for the dynamic money flow index. And what this is telling us, from this period here in the 15th of March, while we still have our crude oil chart open, we made our high up on the 7th of March. And at or around that time, the indicator started turning red in terms of the moving averages. And what this is telling us then is, on average, in the past 50 days, compared to the past 100 days, there's been more money flowing out of this actual asset than flowing into it. So how can we use an indicator like this to take our trades? So like I was explaining a little bit earlier in the video, we don't always have to use our indicators to actually take our trading positions or give ourselves signals to take exits as well. We can just simply use the indicator as a representation of how strong or how weak the market is in terms of its trend. We can also look at it in terms of if the market is in an overextended or a underextended kind of point of view. So if we're looking at the dynamic money flow index again, what I would do if I was looking at this index is, even though we are pretty much been trading above the 0 line, now you'll see if I zoom all the way out before we had the crash there in the crude oil price, we can see that basically since the 15th of June 2020, because this index has been trading above our 0 line, which is over here, it's telling us that net since June 2020 there's been more money flowing into this asset than flowing out of it. We can either look at the moving averages depending on our time frame, or we can just look at that specific line and say, well, since the fact that money has been flowing into this index consecutively since June 2020, then even if there are short setups and I have a time frame on say 15 minutes or 30-minute entry signal that I use, why would I want to take any short trades in this asset when I know over the long period and over the long trend that money net is flowing into this asset? You see, yes, we may find some really good short trades, but over the long haul, we'll probably find that it'll be a lot more successful if we skip those short trades in an example like this and just take the long trades. So again, what it really just comes down to when we're using the indicators is we're trying to give ourselves the best probabilities in our trades. There are 4 points that I just want to summarize and go over with everybody. Number 1 is to be objective. Whenever we're doing our technical analysis, we need to be completely objective in doing so and not be subjective. Number 2, don't tell the market what to do, let the market show you what it's doing. And this comes back to our first point. When we have a subjective view on the markets, then our technical analysis becomes subjective too. And so instead of us seeing what is actually going on in the markets, we are kind of putting our own beliefs and what we think is going to happen in the markets into our technical analysis too. The third point is look for probabilities when doing the analysis. Remember that as traders, we are looking to find setups and opportunities that are giving us the best probabilities. Understanding that yes, even though we find a really good trade that looks amazing on paper and that may even give us a 70% chance of winning, there is still that 30% chance that we can lose, so we need to accept that before we take any trades. And then number 4 is to try and do your technical analysis as if you were not going to trade, but you are going to post the analysis online in an article. So again, this will come back to the point that I first made, which was be objective in our analysis. That means we are going to be doing our analysis completely objective, and traders, I'm sure that if you do it this way, you'll probably find a lot greater results in your trading.